This is Earl White. This is a video about mortgage contingencies. What is a mortgage contingency? Key features of the mortgage contingency and practical considerations that buyers and sellers should consider when negotiating and finalizing the mortgage contingency as part of a real estate contract. So first of all, what is a mortgage contingency? Mortgage contingency is a contract provision in a real estate purchase and sale contract whereby if a mortgage gets denied, that the buyer has the legal right to terminate the contract, be free of any liability with the seller, and have a prompt return of their deposit. The features of the mortgage contingency, there's a few standard features. First is the type of mortgage that the buyer is going to apply for. For residential, you might have conventional, veterans mortgage, VA, Federal Housing Administration, FHA, and those would be the most common ones that people would use. For investors and commercial properties, then you might have a commercial loan. You might, if it's a fix and flip type scenario, you might have a hard money loan. And then I guess there's derivatives of those types. So you'd always have the contract specify the type of mortgage that's in the contract. And that's important because if you don't do that, it kind of gives leeway to the buyer to play some games, or just maybe not play a game, but not be tied down to some specific type of mortgage. When if it's an FHA mortgage, that's a sign that the buyer might be less qualified than a conventional. So you wouldn't want the buyer to pose as a conventional and then be able to apply for a different type of mortgage. Or maybe you are open to that. So it's nothing wrong for a seller to be open to that, but you at least want to know what you're getting into on the type of mortgage. Now, so one is type mortgage, two is the amount of the mortgage. So basically the amount of money the borrower is looking to borrow from the lender under the mortgage they're applying for. Typically people, most people don't think of it in terms of an amount. They might think of it in terms of percentage down, 5% down, 20% down. Most people think about the mortgage amount in that regard. So basically if it was 20% down, that would mean that on the purchase price, you're putting 20% cash at the closing towards the mortgage. If it was 10% down, then you'd be putting 10% down cash at the closing towards the mortgage. So people usually think about the amount. But again, similar to the type of mortgage, you want to know how much your buyer is putting down. The more money that they put down, it indicates they're more affluent, have more capital, and therefore they're probably a more qualified buyer. So if someone's submitting an offer, you'd want to carefully consider how much they're putting down, because if they're only putting 3.5% down, that probably means they don't have too much extra capital, because you would only really do that if you're a little bit tight on funds. So you want to also have this mortgage contingency to specify the amount that the buyer is going to apply for. So the next part of the standard part of the mortgage contingency is the time frame. What's the time frame? And there's two parts of it: the time frame to apply for a mortgage, and then the time frame which the buyer must receive the mortgage approval, often called the mortgage commitment, in. So traditional timeframes for application, like in base contracts, is usually like 10 days to apply, and then 30 days, if you're just using defaults, then 30 days to get a copy of the mortgage commitment. Obviously, I think more common buyers are going to apply much quicker than 10 days because if you know what you're doing and you've been thinking about it, there's no reason to sit around for 10 days. But maybe a buyer does take advantage of that if they're shopping around for rates and they really want to get specific terms, then yeah, they might take the 10 days. But you do want to have something in there to kind of have the buyer tied to apply, so they're not applying later, like late in the process, and then they're going to drag on getting their mortgage commitment by the deadline. So like I said, the time frame to get it approved, the mortgage approved, which would be the satisfaction of the mortgage contingency, meaning that the buyer no longer has the right to cancel the contract under the mortgage contingency, absent special circumstances. Then if they don't apply, then it's unlikely they're going to reach or get their commitment in that time frame. So maybe they still can, but it creates more of a risk that they're not going to get it. Now, in practice, the dates are flexible. The party's usually not going to run around after 30 days and they don't have a mortgage commitment seeking to terminate a transaction or bring some type of lawsuit. But it is important to monitor the deadline, because once it goes considerably past the 30 days and you're in the seller's position, you may want to look into terminating the contract because they can't get a mortgage approval. Usually that wouldn't be a breach of contract on the buyer, but the seller would be able to essentially say, okay, look, you haven't gotten your approval. I'm going to cancel this deal. I'm going to give your deposit back, and I'm out to move on to a different buyer. So the seller also has the right to cancel usually if the mortgage contingency is not satisfied by the buyer. Now, those are the key features of it. So those are like standard, you should always have those in the contract. There are some like more nuanced provisions that all the parties should consider. So first is a denial letter. And a denial letter, the idea is that if a buyer can't just show up and say, oh, my mortgage got disapproved and now I need to cancel and get my deposit back, they have to provide some kind of written statement stating the reasons that they were denied, for which the seller can then verify that you were truly denied. And also that the terms that you applied for were consistent with the contract. Because you get a lot of this, right? I get a lot of clients like this. They talk to someone, they talk to some party, and the party tells them just put something down in the contract. It doesn't matter. We'll change it later. Put conventional mortgage in the contract, get your offer accepted. Then we're going to switch to FHA on the back end, and everything will be okay. Which is, it might be true, but where the problem comes, and I think when people give that recommendation, they don't think through, is that yes, maybe that goes forward and you don't end up getting denied. But what happens when you get denied? And the seller says, show me your denial letter, and your denial letter says FHA was what you applied for, and we're supposed to be conventional. So that they're not going to honor your mortgage contingency if you applied for the wrong amount down or the incorrect mortgage in the contract. Basically, you were bound in the contract to apply for a specific mortgage and you didn't apply for it. So when you produce that denial letter, then it's going to get rejected by the seller. So you want to have a denial letter requirement as the seller in the contract so you can verify that they applied for the right type of mortgage. So that's one for the seller, and that's pro seller. As the buyer, this is more for commercial deals than residential. But as a buyer, you could have a provision that is not just letting you cancel if your mortgage gets denied. As a buyer, you could have a provision that you may cancel the contract if the terms you've been provided are not acceptable to you. For example, say you're applying for a commercial loan, and residential, you kind of know what you're getting into when you're applying. You kind of know. But for a commercial loan, the terms can be completely, you have no idea or you may have a limited idea about what your terms are going to look like because they are more complicated. You haven't seen the mortgage, which will be a custom mortgage document, so you don't know exactly what the terms are going to be when you leave the fully signed contract, because it's just harder to know that. So you might want to add a provision into your contract that says the buyer can cancel under the mortgage contingency if their terms are not the terms they're provided are not acceptable. So basically, it doesn't have to be denial. It can just be the buyer has discretion that in these 30 days or 21 days in this period, explore your mortgage options. If you're even if you're approved, if the terms are not great, you may cancel at your discretion. As a seller, you might not be cool with that. Because as the seller, you're like, hey, you got approved for the amount of money. Like, it's unfortunate that you have this term or whatever terms that aren't great about interest rates. Whatever term as part of the commercial loan you couldn't get approved. And for example, there can be small ones like early, so for a residential loan, you can always pay back early. You can always pay back no penalties. Commercial loans are not like that, right? You have to pay pretty hefty penalties. I mean, it depends. Again, this depends on the negotiation point. If your interest rates are high in this environment and you get a mortgage, like, okay, I want to do this deal, I want to get this mortgage, but my interest rate's so high, my real intent is that in 5 years I'm going to refinance this and get out of this interest rate. But if the bank and you might not know this up front until you get towards the end of the process, and if the bank says, okay, you can cancel the mortgage, either pay it off or refinance in 5 years, but we're going to hit you with a penalty of 2% or whatever the penalty is going to be, right? So all of a sudden it's like, damn, my plan was a certain way, but now, or maybe you can't do it. Maybe there's no way to do it. So that's just an example of a term that you probably wouldn't know in the beginning of a real estate contract for a commercial loan, and then you kind of learn about it. You might be like, oh wow, even though I'm approved, the terms of this mortgage are not what I thought, and I really want to get out of this deal. So that's like some considerations about with the buyer having a right to cancel if the terms aren't great. The next thing you want to consider as part of the mortgage contingency and you're drafting it is what conditions because you get these what conditions of the mortgage contingency, what conditions of the mortgage commitment are acceptable for satisfaction of the mortgage contingency. Because we talked about the seller having a right to cancel because the buyer's not getting approved, right? So we talked about that. Now, what if the buyer produces this mortgage commitment to you and it's like buyer. I'm gonna give you an example. Here's an example. One time we got a mortgage commitment. I had the sell side. We get this mortgage commitment, which was 2 weeks late, and we finally get this mortgage commitment that says buyer like has a shortage of $7,000 and must show how they're going to get. You know, it's like this is a weak mortgage commitment. Why would they even write that in a mortgage? How can you issue a mortgage commitment if the buyer literally does not have the money? Like literally does not. So this is my point. So as a seller in the mortgage language, you may want to add a requirement that the conditions need to be within the buyer's control in order for the mortgage commitment to be satisfactory. This way, if the buyer is short, if the lender, because the lender can issue mortgage commitment to a piece of paper, I mean, virtual paper, and it just has a list of conditions. They can have 2 pages of conditions sometimes. So it's pretty much worthless. Also, you could have a mortgage commitment contingent upon the appraisal. So basically they're approving you subject to the appraisal. So I would always add language that like, you know, if it's subject to the appraisal, we can reject it. Because, I mean, what kind of commitment is a lender really giving if it's contingent upon the appraisal? It's like the biggest condition. It's more or less not all lenders do it, but many will give the commitment subject to appraisal, which is fine. But I would always add language that we don't have to accept that for the mortgage commitment because like, it's like the biggest, it's probably the most important, the approval aspect of the mortgage commitment. So yeah, mortgage lender can spit out a piece of paper that has all these conditions, but if the conditions is appraisal or not things within the buyer's control, it's kind of a worthless piece of paper that you could draft language to have it. You could draft language for the seller to be able to reject it, or you don't have to just reject and cancel the deal. Like, hey, look, this is crazy. Like, you don't have the money in your pocket. We don't have an appraisal. You get all these things taken care of, and then we'll accept your mortgage commitment and we'll proceed to close. So that's another consideration. Now, speaking of the appraisal is different than a mortgage commitment. Sometimes you will hear people say, well, we don't need an appraisal contingency, or you could do a complete appraisal waiver, but that's topic for another video. But appraisal waiver basically means that in the event of a low appraisal, you have to make up whatever amount of money there is shortage in the mortgage. But the appraisal is a different consideration. So if the appraisal is a different consideration, so you want to be careful to have appraisal contingency language because you could get an under appraisal and still get approved for the mortgage. In other words, it's not if it under appraises, it's not an automatic denial of your mortgage. Maybe you could twist the arm of your lender if it under appraises, have a conversation. Hey, can you please deny this mortgage because it's under appraised and it's not what I thought. And then they could be like, oh, okay, sure, I'll give you your denial letter so you can get out of your deal. But not all lenders are going to do that. Some will fight you tooth and nail before they're going to issue you a denial letter to justify the cancellation. So the point being, you want to have clear language of appraisal in the contract in addition to the mortgage contingency, because they are distinct aspects, and sometimes the buyer should be aware that they're distinct. So they should be aware that they might get approved for a mortgage even with an under appraisal and have a lower equity position, possibly be paying purchase mortgage insurance if they're now less than 10% down on the appraisal value. So that's another consideration for drafting this mortgage contingency. And last one I'll go over is when you lose the mortgage commitment. So let's just say the loss of the mortgage commitment. Person gets approved for the mortgage, but they lose their job a week before the closing. Or the lender makes an error in the approval, which I've seen. An example that I came across, which was kind of egregious, was we got the mortgage commitment based on child support payment that the buyer was receiving. But then the person who was doing the approval didn't realize that the child support was coming from New York. And the way the law worked was that the lender actually could not consider income in New York. They couldn't consider child support income in New York because the way the law worked in New York was that at the age of 18, it had to get renegotiated. Again, I'm not a family law attorney, but the understanding of the New York law was that it's only good up until 18, and then at that point it has to get revisited. So basically they were approving them for this income, counting the child support in New York, and then it turned out 2 weeks before the closing or a week before the closing that they couldn't count that income, so the mortgage commitment had to get withdrawn. Really no fault of the buyer. The buyer told them everything, and they got approved. So it was truly a lender error. They truly had all the facts. They approved the mortgage, and then the facts that they approved the mortgage on were not approvable. So you can run these situations with lender error, changed job circumstance by the buyer, and you often see with homeowners associations where you collect the homeowner associations where they'll approve the buyer, but my understanding from my lender friends, because I'm not on this side, but my understanding from my lender friends is that there's like a dual track for the mortgage approvals for associations. So one is there's like a track for approval of the buyer, and two, there's a track for approval of the association. And so you can get the buyer approved, but sometimes that association might not get approved down the road. And then that can result in the buyer getting approved, but the approval getting withdrawn. And that's a little different than a lender error, because it's hard to get information from these homeowner associations, right? Everyone would so I can understand that due to no one's fault, the lender can't get the HOA approval at the mortgage time frame. They can approve the buyer, but it's hard to get the HOA approval, which in my experience, that is something that, despite best efforts, it's just hard to get that track of the approval done. So that part might lag. You might get the buyer approved first in the time frame, but then it gets withdrawn because that second track of the HOA. So that's why with HOAs, I would always have language in the contract that if the buyer loses the mortgage for reasons beyond their control, not their fault, exactly like the second track of HOA, that they can withdraw their mortgage commitment legally and cancel the contract, even though they would have given a mortgage commitment. Basically, it got withdrawn, not their fault, so no harm. I mean, it's kind of a bad situation for everyone, but the buyer will not legally be in breach because it was beyond their control that the mortgage got withdrawn. Okay, guys, that was the video. What is the mortgage contingency? What are the key elements, and what are the considerations the buyer and seller need to be thinking about when drafting that provision?